Hi, it's the Catholic CEO, Henry Kutarna. Welcome to this Catholic Business Wisdom series. Topic today, money management. This topic applies both in your investing portfolio, your investing strategy, as well as in operating your business. The concept of money management, I've got 9 sections to review with you today briefly. If you follow these 9 approaches, you're going to be experiencing greater control over your finances, and perhaps most important of all, you're going to have an actual plan, a strategy, a way of measuring your financial performance. So let's begin with first topic, number 1, capital preservation. The game plan here is to keep preserving your capital, and that means, in a simple sense, if you put money into an investment, let's say you invest $10,000, or you buy stocks worth $10,000, or you put $10,000 into your business as a cash injection. The concept of capital preservation is that you want to, as soon as possible, take out that capital. So, for example, if you're in the stock market and you make some good investments and let's say you gain the appreciation in value of the stocks, you've got more than the $10,000 that you put into it originally, take out the $10,000 and preserve that capital for use elsewhere. If you put $10,000 into your business as a capital injection, for example, well, take it out at some point when it's appropriate to do so, but always have in mind that you can take it out as a tax-free return of capital, and then you can use it somewhere else. And so, similarly, when you're investing, you can make sure that you always preserve the capital, take it out when possible, when it's advantageous to do so, and do it on what you call a tax advantage basis. Do some thinking about how to take it out in terms of basically getting yourself a good tax deal. Sometimes depreciation charges can be used to take out capital. So those are the concept of capital preservation. Develop a strategy for that. Let's move to number 2, cash flow management. Really, most businesses fail because they run out of cash. This is an old truism. I know you know it, but think about it. If you don't manage your cash flow, or at least monitor it on a regular weekly basis so that you understand how much money is actually available to you in your bank account to take care of regular expenses and also to take care of anticipated expenses over the next quarter, the next 6 months, the next year, and certainly the surprise expenses that always happen in a business. So monitoring cash flow to make sure that you have available cash and making sure that you know where your cash is coming from. For example, in your collections policy, if you have accounts receivable, well, speed those up. Tighten up your accounts receivable policy so that you can have more cash available sooner in your business. So the concept of cash flow management does not require you to become a financial expert. It doesn't require you to become, an accountant or a tax expert. Cash flow management is simply watching that bank account to see how much money you have available versus how many expenses you have to cover in the next period of time, and making sure that you have the money to do that. You can use your line of credit to balance off the peaks and valleys, yes, but remember, paying off the line of credit is very important, and not to leave the balance. If possible, you need to bring it back down to zero as often as possible, as many times a year as possible, and as frequently as possible. Third topic today, margin control. Margin, the difference between your price that you receive in the marketplace for your product or your service, and the costs associated with that. That's my simple definition. There are many more complicated definitions, yes, but margin control. Control on a weekly basis. Check every week what you're selling your products for, your services for, and what the expenses associated with that are. It's going to require you to have a weekly dashboard indicators. We've talked about that before, but if you set up a weekly dashboard, you'll be able to understand what you're getting in terms of margin every week. The object of testing it weekly is to make sure you don't get off course. We've talked about this before. You get off the course by 1 or 2 degrees. fairly easy to get back on course. But if you get off course by 50, 60, 80, 100 degrees, turning that ship around is a laborious process, and it's going to be very difficult. So watch your margins. It's the best way to protect your profitability. And it's a simple test. Once again, you don't need to be an accountant to understand this. You just need to pay attention to margin on a regular basis. Topic number 4 for today, ROI, return on investment. I think it's important that you would learn and appreciate how to calculate return on investment. If you have capital invested, you put in $10,000 into your business, well, measure how much return that $10,000 has gained for itself. And this is often done to compare types of investments. There can be a cost-benefit analysis. We won't get into that today, but you understand the concept of checking the return on any investment that you make. There are several mechanisms, several measures. One is return on capital, one is return on equity, one is return on investment, ROI. You've heard this expression before. The idea is to calculate and measure the return that your investment is getting. And yes, there's targets that you could set. You could say, I want 10%, I want 15%, I want 20% return. Sure, but at the very least, start measuring it so that you can see changes in your return on investment. Let's say seasonally, let's say adding new products or adding a new market, or suddenly costs come along, or there's inflation. The return on investment calculation, if you don't look at it every week, or let's say once a month even, you're going to miss the signals. And so you can hear me speaking here, the subtle language is measure on a regular and frequent basis. That's how you're going to keep control of your money and manage your money well in your business or in your investment strategy. Number 5, profit and loss metrics. Once again, you can see the theme that I'm pumping out at you today. Measure on a regular, frequent basis. What are your profit and loss statistics for a period of time, this week, this month, this quarter, compared to last week, last month, last quarter, for example? 12-month trailing average. Look that up. It's a very, very important signal of how your business is doing, because it removes seasonality and cash flow fluctuations. It removes seasonality. It's a really good measure, 12-month trailing average. Check. Another way to do profit and loss measurement is by product, by market region, by segment. If you try to measure profit and loss in those ways, you get a very rich set of data about your business. And none of these take too much time. They're easy to set up, not too complicated, but they actually give you important signals about your business, not only one by one in sort of direction, red light, green light, yellow light, up, down, those kind of regular signals, but also as a whole. They give you a composite kind of view of your business, and you absorb that. You see that on a regular basis. Let's say you do it once a week, once a month. You're going to learn about the subtleties of your business. And why do we want to do that? Well, to pay attention to the small signals that will occur to you, and if you have a good subtle knowledge of your business, you're going to be able to interpret the signals and take action. That's the point, to take action. Point number 6 for today, debt reduction. Obviously, you want to pay down debt. So when you have a line of credit, try to knock it off. Try to get it back to zero. If you have an equipment loan or a lease on a vehicle or something like that, you're going to automatically reduce debt because they're going to require that monthly payment from. But the ones where we get into trouble are when it's discretionary, like the line of credit. If you leave that balance at the full level, you're just going to continue to pay interest on it. And of course, the success of your business is measured by how you can reduce your debts, and especially paying attention to the line of credit. Many businesses keep that line of credit maxed all the time. And I can understand how that happens. There are lots of circumstances why. Remember that the line of credit was developed really to take care of seasonal or variable fluctuations each month. When you have to make payroll and you've got some accounts receivable coming in and they're going to come in on this 3rd, 4th, or 5th of the month, but you have to pay on the 31st or the 1st of the month. Well, you have to have your line of credit ready to handle that. And if you are maxed out, well, you get yourself into some additional problems. So debt reduction is a thing. It's very difficult. It's challenging. But the thing is, if you use all of these tools we're talking about today to manage your money, you at least will not be surprised, and therefore you will have time to prepare. Or if you are hit by a sudden shock, at least you will have, well, foreknowledge of it. You might say you'll see it coming to some extent. Sometimes there's a full surprise and you don't see it coming. But the point is, if you have a strategy of debt reduction, you're going to create yourself room in your financial situation to take care of emergency. Point number 7, financial simulations. You can see where we're going with this entire discussion today. It's important that you learn how to, or assign to somebody, certain spreadsheet scenarios that you do on all of the above things we've talked about, but also on scenarios for the future of the business. You should be simulating on a constant basis. What's going to happen next quarter if I can raise my prices? What if I can't raise my prices? What if there's competition and I have to lower my prices? How will I then reduce my costs? How will I then remove certain expenditure items? How am I going to take care of changes in the global marketplace? Let's say inflation continues, or let's say there's a sudden, shock in the supply management system and in the supply chain. What happens if something occurs to my business? It's important that you keep doing these simulations, not to scare yourself, of course, but to be understanding of what possible scenarios in the world economic situation could affect your business. Part of the simulations is to read a certain amount of the literature that comes out, the reports that come out from think tanks, certainly the monetary authorities in your country, and definitely the banks and the big consulting houses. They all issue reports and forecasts. You don't have to scare yourself. You don't have to drown yourself in volumes of paperwork and reading lots of reports. But it is important to pay attention to that, because you can hear the signals, and some of it is groupthink. You have to be careful. You have to be smart. But it is important to be aware of what the experts are telling you about the direction of the economy. And some of it is contrived politically, just be careful about that, and some of it is actually part of the the monetary policy and the fiscal policy of governments. And so we have to pay attention to that and translate what's happening at that high level down to what's going to affect my particular business. Topic number 8, setting targets and goals. You can see why this is obvious. You need to, as you do all of the above things that we are talking about today, set yourself some targets and goals. And in the beginning, you may not have precision. You may not really know what type of target you could set. How much is too much of a growth in revenue? How much is realistic? What's unrealistic? But as you gradually make a maneuver and test to see the result of that activity, you can start to set reasonable and professionally, I would say, realistic goals and targets for your business. And that's important, because what is the purpose of our business? Well, we need to take care of our families and pay the payroll and do the things that are good for our customer, provide them the value, the services, the products that they want. But at the same time, the business is a machine that pumps out cash. What is the purpose of that? Are you funding your pension plan, for example? Are you going to sell this thing and then create a capital gain for yourself from which you're going to pay your pension? Are you going to support your family? Are you heading in the direction of perhaps giving money to charity and so on? Whatever targets and goals you have, they have to translate into financial targets in your business. And so this is why we have to focus on setting targets and goals. Item 9 for today, I call it the de-risking strategy. Life is full of risks. Our businesses are full of risks. We can always be subject to the surprises that the marketplace gives us. I know you know that. As a money management tool, de-risking, in history, many people have done many different things. I know people who talk about buying gold or silver as a store of value and as a hedge against inflation or crises in the economic system. Sure, do it. It makes sense. Digital currency is something that didn't exist 20 years ago, but now it does. And so you could invest in the digital currencies, the Bitcoin. You have to be careful because if the internet goes down permanently, well, how do you track a digital currency? So I'm not trying to frighten. I'm just trying to say be careful about these things. But as a diversification strategy, as a de-risking strategy, you never know. Digital currency could be a thing. Some people invest in unusual things. For example, I know individuals who invest in exotic vehicles, classic cars, because they tend to hold their value. Now, it's difficult to transport around if you're, trying to, how do you sell a portion of your classic car in order to meet some monthly expenses? That's the problem. But in a diversification strategy, you never know. If you're a car guy, if you're somebody who loves vehicles, you might actually put some of your assets into something like that as a store of value. Classic cars tend to increase in value or at least hold their value. Now, you have to know what a classic car is, and you might have to know a lot about it. But that goes for anything we're talking about. You have to know what you're doing, and you have to be pretty aware of the marketplace for that. Some people talk about artwork. This is historically perhaps the most famous example. You buy artwork. I know people who have a modest or a large collection of art, and that collection usually appreciates in value. Once again, you have to know what you're doing. You can't just buy junk art. You have to buy good quality art, and therefore you need to have some expertise. But it all requires expertise. The point is, if you can keep your wealth, your eggs not all in one basket, and diversify your strategy and de-risk various methods of holding your wealth, then you're going to be smarter because you're going to spread the risk. That's the game, is to spread the risk. Remember, though, you have to know what you're doing in these areas. You can't just wildly kind of invest in classic cars or art or digital currency if you don't know what you're doing. As always, it's important to be aware, seek advice, get good professional input on it, and prudentially think about whether it's right for you. If you have a small portfolio and you have a net worth of, let's say, $50,000, you're not going to buy a classic car. But if your net worth is $5 million or $10 million, well, you might have 2 or 3 classic cars in your collection that total, a couple of $100,000. I'm using these examples just to make the point, and I know you get what I'm doing. In general, then, in summary, what we're trying to do with money management is use all the 9 tools that I discussed today, get familiar with them, utilize them, start to practice, execute well, do these things. You'll find that you will be more highly aware of what's going on in your business or your investment strategy. You'll be able to then use these tools to simulate, to understand, to make course corrections, and to just have a picture of your business. And the point is to do it on a regular basis with, here's the word, specificity. That means micro management of these issues, thus leading to macro solutions, which then can preserve your wealth, improve your cash flow, improve your handling of your money, and make you a professional, as far as that goes, in your business or in your investment strategy, a more professional manager of your money. And that's what we need to do as Catholic business owners and as people who are prudentially wanting to manage those tools that, you could say God has given us, that we're using to make business and to make wealth and to preserve the income and the money machine that is funding our families and our future. So God bless you in your works. Remember, you can be Catholic and successful in business. It's the Catholic CEO, Henry Kutarna. See you next time. God bless.